Okay, you are live.
Good morning. This is the first meeting in 2024 of the City of Annapolis Police and Fire Retirement Commission. We have a quorum. I welcome everybody to the meeting. Uh, Best wishes for the new year to everyone. Uh, Before we get started, um, I saw a notice that went about a week ago. Joe Karpinski, who used to work with the board as a consultant, passed away. Uh, Joe provided valuable services to the city of Annapolis Police and Fire Retirement Commission, served many years with us, was a very fine human being, and I wish his family well. Um, that said, in today's meeting, we are going to be joined by a colleague of Ian's, Jeff Brzezinski. Is Jeff on yet?
I don't see him.
Okay, well, at the appropriate time, Ian will introduce him to us. He has replaced a staffer who used to support Ian before, providing services to us. The agenda for the meeting was passed around earlier. One of the first items of business for us is to look at the minutes of the last meeting from November. Those were circulated for review. Were there any comments on those minutes? Anybody proposing changes, corrections?
I do, Joe. The 7 million to IFM for infrastructure, are we also, I apologize, I don't recall. Are we doing 7 million to both Brookfield and IFM, or is it just the initial 7 million to IFM?
The decision at the last meeting was just 7 million to IFM. We already have an allocation to Brookfield, and at that meeting we said we would potentially further discuss an additional allocation to Brookfield to potentially increase the Brookfield allocation to 7 million from the current.
Got it. Okay, thanks, Ian.
Yep.
Any other questions about the minutes or actions taken? And if not, could I have a motion to accept those minutes?
Make a motion.
Motion. I'll
Those
second.
those in favor, aye.
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 Anyone opposed to that? And without opposition, those minutes are adopted. Um, Bear with me one second.
Jeff said he's having trouble with the Zoom link. Nikki, would you be able to send him the link again?
I will.
Well, we can go on.
Okay, and with that, let me turn the meeting to Ian to present an overview of the investment markets.
Okay. I'm going to share my screen. So here we have let me make this a little bit bigger. Here we have a summary of market returns for the equity and fixed income markets in 2023 and going back a couple of years. And we had, after a tough 2022, the markets were considerably better in 2023. But the markets, the numbers don't really tell the full story. Leadership in 2023 in the equity markets was somewhat narrow for the majority of the year. For the majority of the year, there was a handful of stocks in the technology space that had some sort of tie to artificial intelligence and that platform. And those stocks, which you might hear referred to as the Magnificent Seven, were attributable to the majority of the market's performance in 2023. So depending upon where your allocations were, if you were an active manager, your performance was potentially substantially different than the broad market if you didn't have market representation or the same weighting in those those technology stock names. But we had a great year both in equities and in bonds. And the S&P 500, which is representative of generally the broad large cap part of the market, was up more than 26%. And mid and small cap stocks were up double digits, but they trailed. And the reason they trailed is that the mid and small cap parts of the market don't own those large cap growth names that drove the broad market performance. But still, mid and small cap were up in the 17% plus or minus range. And you can see the difference in performance between the broad market or the growth market and the value. The Russell 1000 Growth Index, which includes the Magnificent Seven stocks, was up almost 43%, but the value index was up just 11.5. And 11.5 is great, but it's one of the biggest differences between growth and value that we have seen. And the international markets were positive. Developed international was up 18.25, and the emerging markets were up almost 10%. And then fixed income had a decent year, and the bulk of the market's positive return came at the end of the year. And the reason it came at the end of the year is that the government made the notion that they may be done with interest rate increases. And as a result, the fixed income markets reacted favorably, and we had a generally falling interest rate environment toward the latter portion of 2023. And when interest rates go down, bond prices go up. And so that's what we saw happen in the last quarter of the year. You can see very strong returns in the last quarter of the year. And basically, we were in negative territory going into the last quarter of the year. And so the investment grade bond market finished the year up about 5.5%. Investment grade bonds of corporate bonds of investment grade were up 8.5%, and high yield bonds were up 13.5%. So the riskier part of the market, high yield bonds, produced the best results with very attractive yields and principal appreciation as the high yield part of the market yields fell over the course of the year. One takeaway is that yields do matter today. And so this figure called yield to worst, that is the yield of the respective index. If you were to hold all the bonds to their roughly average maturity, you would get, for instance, about 4.5% from the investment grade Bloomberg aggregate, and you'd get roughly about 7.5% if you were to hold all the bonds in the high yield index.
One thing to note for commission members, we report to the city on a June 30 basis. So should you be talking to anyone who looks at our annual report filing, they will see a different result as a starting point for their conversation than what we're looking at today.
All right. So this particular chart goes over returns in 2024, and we've gotten off to a decent start on the equity side. We're actually have been hitting in the large cap, the S&P 500. We're at historic highs. And so the year-to-date column is the roughly 22 days in January of 2024. And so you can see the S&P 500 in January is up about 1.75%. But we've had negative returns coming from small and mid-cap stocks. And again, we've had leadership in the growth side of the market. You can see growth is up 3.33%, where value is up or is down roughly 0.5%. And the international markets have been down. Developed international is down about 1.6. Emerging is down 5.8. And we've had backup in interest rates. And so we have seen negative returns coming from the bond market again. And you can see the year-to-date returns for the various sectors, the S&P 500. But again, the story and the leadership, you see NVIDIA. NVIDIA has been one of the strongest performers over the last decade. And NVIDIA in the first 22 days of the year is up more than 20%. And you can see the trailing year, they're up 234%. And the trailing 10 years, they're up 65% per year over the last decade. So, any questions on that? I threw in here performance for calendar year 2023. I really have gone over that already. And this is a chart which goes over the impact of the Magnificent Seven stocks. And you can see that the contribution of those 7 stocks, this is on a price basis. And you can see that the weighting of those stocks in the S&P 500 is 28%. So 7 stocks represent 28% of the market value of the S&P 500. That's how big those companies are. The returns of those companies in 2023 are detailed here. And then the attribution or the contribution to return, as I mentioned, the S&P was up about 26%. 15% of that came from these 7 stocks in 2023. So another way to look at it is those stocks on average were up 76% last year. The S&P was up 26% and change. If you took the performance of those stocks out, you would have been up 13.8%. So a big contribution by a small number of names. This chart shows the returns of the S&P 500 and the Bloomberg Aggregate Index on a calendar year basis. And we came off of 2022 where we had negative returns from both the S&P 500 and the Bloomberg Aggregate. We show results here back to 1976 when the Bloomberg Aggregate Index started. And the majority of the time, we have positive returns coming from both equities and bonds. 2022 was an aberration, and it's nice to see that we were back in the northeast quadrant in 2023. And here we show the yield curve from when yields were basically at the bottom back in December of 2021, and we show yields 2 years later, and we've had an appreciable rise in rates, and we have something called an inverted yield curve. So right now you can go out and buy a money market vehicle or a short-term treasury security, and you're going to get a roughly 5.5% yield. Now that is for a short period of time, and if yields start to move down, these yields will come down. But you get more than 1% in yield in a short-term, high-quality treasury security versus a 30-year bond, which is yielding about 4%. And but in general, we've had an appreciable rise in yields, and that's what is attributable to the negative return coming from investment-grade bonds over the last couple of years. And this is a chart which I've shared with you before, but it shows that after periods of significant market loss or drawdown, and we've had a number of them over the past 2 decades. We had the dot-com bubble, or noted here as the tech wreck, back in 2001 through 2002. We had the global financial crisis back in 2008, where the market lost more than 40% of its value. We had the coronavirus drawdown back in 2020, and then we call it inflation and interest rates in 2022, where we lost more than 25% of the value of the market. And what we like to show is that if you're patient after those market drawdowns, we typically see strong returns in the years that follow a significant market drawdown. And so we show the returns 1 through 10 years out after the tech wreck and the global financial crisis. We show the returns 3 years out after the coronavirus drawdown. And we now have 1 year to share after the interest rate and inflation impact. And 1 year later, we're up 24%. So this is one of the arguments for being patient after near-term market volatility, because with patience, we typically see some sort of recovery over time. And we do something similar with the bond market. And if you go back to 1976, we've had 4 periods where we've had losses of greater than 5%. Back in the 80s, we had 2 of those periods. 1994, a rising interest rate environment, we were down more than 5%. And the worst period was rising interest rates in 2022, where we were down more than 17%. But again, if you're patient after those periods of rising rates, eventually rates start to fall and you see really substantial returns coming from the bond market. And that's because the government raises rates to try to slow the economy down, and eventually they will succeed. And then what do they do after that? They will start to lower rates to try to stimulate the economy. And when you lower rates, bonds go up in price. And with that lowering rate environment, you generally see very positive returns coming from the fixed income market. This is the chart that shows the S&P 500 from just before the global financial crisis until the most recent days. The blue parts of the chart are where the S&P 500 loses 5% or greater. The takeaway here is that in general, the market goes up more than it goes down, but it comes with bumps in the road. And you got to live through those bumps to see the value add. And this is a chart that puts it into longer term perspective. Bull and bear markets going back to 1945. Bull markets are in green, bear markets are in red. We've had 14 bear markets, 15 bull markets. And the takeaway here is that the bull markets far outweigh the bear markets. And bear markets are a given that we will, and a bear market is defined by a loss of 20% or greater. And we had that loss in 2022, and we've now recovered from it. So at the end of January of 2023, far right-hand side, we have recovered from that bear market. And so that is the 15th bull market since 1945. In general, over this entire time period, the S&P's gone up by about 11% per year. But you've got to live through these bear market periods to be able to recognize that 11% return. This is a histogram that shows the calendar year returns. And it's interesting to note that since 1926, the average return has been about 10.2% for the S&P 500, but we've only had 6 calendar years where the rate of return of the S&P 500 has fallen between 8% and 12%. So average of 10.2, but a very small number of calendar years over that 97-year period of time fall within a range of 8 to 12%. And I think, one of the takeaways is that, returns greater than 20%, there's a lot of them. But the hard part is picking those years where the market is going to return that level of return. And then this is the market timing chart. This goes back to October of 2007. And if you could be invested, or if you were invested over that time period, you would have earned 9.25%. And if you missed the best 5 days of the S&P 500, just 5 days, your return goes down to 6.2. You miss the best 10, your return goes down to 4.15. You miss the best 20, your return is almost flat at 0.92. Now, conversely, if you miss the worst days, your return goes up. But the takeaway is that market returns are found in a small number of, of days, and it's really hard to pick those days of when to be in and when to be out of the market. And Joe, that concludes my my market commentary.
Thank you for that. Is Jeff now with us?
Jeff's with us.
You want to introduce Jeff to the group?
Oh, let me see. Is Jeff with us? I saying that. Was he able to join?
Here.
There he is. Jeff, welcome. Jeff is my new teammate on the Annapolis relationship. He currently resides out of our headquarters in Winter Park, Florida. And I've worked with him on a handful of relationships. And so I thought it would be helpful for him to sit in and see what we do in our meetings. Gives him a much better appreciation for what we focus on, but also the importance, like the book that we review and the data crunching, the valuation detail. Jeff gets that into our performance measurement system. And then he and I work on the review and re-review and getting it out to the client. So I welcome Jeff to attending this meeting, and I look forward to working with him on this relationship going forward.
And Jeff, we welcome you as well.
Thank you. Thanks for having me.
And with that, I think it is time to move into executive session under that portion of the law that allows us to do that when discussing matters of finance. Can I have a motion to do that, please?
So moved. So moved.
Second?
Second.
Anybody opposed? Those in favor, then aye.